Hi, Warriors. Hello, Shahab. Ryan, how are you doing? Everyone else okay? So, Aussie, I covered from, it was a decent trade from Friday at the 61.8 level. Could
Way
have
to go,
more
Dale.
left.
Great call, by the way.
Thank you, Blake. And, I took that one because I thought there might be a little more risk off. I don't know why it sold off so dramatically. Is that why? Risk off around the globe or what?
Yeah, I think there's just some profit taking going
Yeah,
on. I mean, we've gone pretty far.
yeah,
It starts to get it's like kind of a tougher argument at this point, after this big of a rally in equities to be like, I'm super bullish here.
yeah,
I think as we hit some pretty key levels, and the squeeze is, as I talked a lot about this on the week ahead video. I mean, sentiment's extreme. You squeezed out enough people. You got so much of the market turning bullish at this point that it's hard, really, like, to take a step back. It's a little harder to turn around and get really bullish risk at this point after such a big run. As we were discussing yesterday, you can start seeing a 5 to 7% pullback just to a breakout point. And what's going to be affected the most? Well, you take a
yeah,
currency like the Aussie, and it's probably going to get steamrolled a bit. So
yeah. So I mean, it could still, pull back to here, 67, 6.5, and
yeah,
not, just be a normal correction because,
sure.
I'm not. After last week, it's hard to be bullish the dollar, except for counter trend trading on it right now. And it is positive with the euro being stronger than cable. I was looking at this the other day. Do you think EG has turned?
I don't know. I'm
Nice
gonna
little
ask
rally.
Ryan. I'm gonna ask Ryan that. I think Ryan's
All
been
right,
following it a little closer than myself.
because
Yeah,
last
morning,
week,
guys.
Ryan.
Good
Yeah,
morning,
hey
Ryan.
Ryan, you see this formation? It looks like pretty classic three. And look
Yeah,
at where the RSI was on the last low. Maybe back to the breakdown. Um, this is where it really broke down. Maybe we'll get a breakdown test. What are you thinking here?
yeah, and yeah, well done on the Aussie, mate. Nice grab on that one.
Thank you.
Held up near the highs. I don't think at the moment this is going to see a big correction here. I think this is just that same old volatility difference between cable and the euro. As you said, cable's coming off more than the euro is in
Yeah.
this move. Same as it, when it goes up, cable goes up more than the euro does. We came through the ECB, we came through all that sort of stuff, and the euro sterling couldn't bounce significantly
Yeah.
on that.
Yeah.
This could be just some chips coming off the table. We got a big CPI report tomorrow.
Okay.
But what I will say, and traders need to be aware of this, there's a growing issue over here with mortgages now. Everyone wetting the bed over higher mortgage rates and people getting squeezed and impending property crisis and all. You know how it goes here in the UK. It's either everything's going well or everything's burning to the ground. And I think we're heading to one of those burning to the ground sentiment moments. And
So
that, I
most
think,
people have variable mortgages over there in the UK that
yeah,
float with
it's
rates.
what happens in the UK is you get a mortgage and you can get a mortgage for 25 years or something like that, but you get a deal on the rate for maybe the first 2 or 5 years, so you get a discount rate for the first 2 or 5 years, whereas in the States you get a 30-year deal, you get that rate for 30 years.
Mm-hmm.
So what's happening is that everyone who's come off paying 0.5%, 0.9%, 1% for the last 5-6 years are coming off those deals and getting slammed into 5-6% interest rate deals.
Yeah,
You,
that
you
can
know,
be, that's huge.
I'm sorry. Yeah, Ryan, you know what you're interested. It's very interesting about the UK. Australia does something very similar. And I was watching, or I was talking to the guys that I work with on the trade-off show, and they're like, "Yeah, I've got my mortgage is about ready to reset here this year," and because they do it every 5 or 6 years or something like that. It's like,
Yeah,
crazy. I mean, like, could you imagine, Dale? You're like, oh, well,
Yeah.
you know, here I go. I got a brace for this, you know, my mortgage to be, I don't
Maybe
know,
it doubles the
20%
payment.
higher.
Oh, just
What's
20. 20
Yeah.
wouldn't be a killer, but maybe it's even more than that. Well, 20 is not fun.
Yeah, I'm just saying that, like, you
Yeah.
bracing for that type of like shock, not only do you have a you know, inflation, an inflation issue as it is, but then anybody that's got, you know, a mortgage that, you know, you're like, oh well, I actually own this house. It doesn't matter because you're still paying out the nose.
Yeah.
I mean, it's crazy. Anyway, sorry, Ryan, didn't mean to jump in. It's just
That's
wow.
right.
That's interesting. It's like that in Canada too, I believe.
Yeah, well, without going off the garden path too much, you know,
Yeah.
people should have been prepared when you're paying zero rates or close to zero. You should be prepared for when rates do rise, but as usual, people don't, and they all get caught out. You know, I had a small mortgage when I moved down to Bournemouth here, and 18 months ago, I locked it into a 5-year deal because I saw rates coming up. You know, that's what I traded through dollar yen. So, but people don't have financial education over here, and it's gonna.
See, so being aware of currencies can help you in other areas of your life.
Exactly. But for the UK, it is something, and it's when we get things in the UK, they tend to snowball. So the press all over it, politicians all over it, and if it becomes such a big noise, you're going to get investors worrying about it, and then they're going to start questioning about whether they should hold assets in the UK again. And we know that there's a big amount of foreign money in property here in the UK. So it could become a big deal. And I think it's something that the BOE are probably going to touch on at their announcement of their decision on Thursday.
I haven't done the fibs off this break, but I wouldn't be surprised if we're at an important fib. You think we're topping out here? Yesterday, I think I asked you this, Ryan, too. I think some people are looking for 43, but I mean, we're diverging on multiple time frames. And
Dale, it is the 618 retracement. We missed it by literally 40 pips last night, which sucks because I had a bunch of orders out at like 142.50. I told our whole chat room that I'm like, okay, if we get to 142.50, I'm starting to short the hell out of this thing. And you know,
because yields are rolling over too. I mean, they've made so many attempts up here at 385. I think that this is a negative day. You know what else is interesting when you look at that yen chart, and then you look at the S&P chart. I think that was he had a weekly.
Yeah, Dale, I can't wait to show you all of these.
I mean, does that look similar or what? So, actually, the market's going to break. If the market's going to break, it's not going to be because of higher rates. Rates are coming down because there might be risk off, and I think the yen is saying that.
If you come out a bit on that yen chart to sort of November, it stopped to the pip on the November high, which was the bounce after the break from 145. See that? See that candle there? It's like the third candle along from that big red one, that massive red one. Keep going there. No, you missed it.
Oh, here?
No, keep going there. Boom.
Yeah, look at that.
120, 142.24. That high was there, and we hit it on the pit.
I think we could at least trade 30s. You know, maybe we'll finally retest that breakout at 38 from here, and then under 38, look out.
I want to see if we see another one up to 142 and that holds. I think then maybe you can start calling for a top, be it short term or otherwise.
Gosh, you know, as much as it pains me. I know you guys don't watch the week ahead video because the last thing after working with me all week, the last thing you need to see me is on a Saturday. But I cannot wait to show you these long-term charts in the yen here in a bit. So
why don't you grab them?
Let's
see. I mean, we could cover Stel may want to make some. Let's see, Stel, what do you think about the metals? Well, you know, long term, I'm very bullish, but we're in a range, and you know, you just have to be patient, wait for your spots, and that's what I do. And Interesting, silver's a little weaker than gold today.
Stel, you sound a lot like Dale today. I mean, your voice sounds kind
Thank
of
you, Stel.
Yeah.
I sound a lot smarter today, actually.
Oh yeah, right. So I mean, it's true. What is there to say?
You're absolutely right. What you said.
Yeah,
Absolutely
yeah.
right.
Unless this is a bull flag, we have the flag pole and we're getting a flag here, and we start getting back over 1955, because we could rally to 1980, 2000 and still, not have a breakout.
1985, yeah. But look,
Yeah.
the chart that you're showing, it's full of impulsive moves up, down on this
It
short term.
really has been hard.
So it's just sideways. Anyway, you look at
20
it.
down, 20 up. I mean,
I wish I had something to say about it more, but it's just sideways. If you look at the 1 minute chart, maybe there's more to look at, but I don't.
Gold silver ratio will give us a clue. If we get over 82.5, I guess you could, still be patient about buys in silver. So that's about it that I see. I think we've covered a lot of things. Any comments, Ryan, on the yuan? We had blank in there yesterday, and
yeah, we had the rate cut last night.
Oh, they did. Okay.
Yeah, one of the LPRs, the 1 year and 5 year. So that's all. That concludes this round of all their little rate bits and bobs that they've been cutting. I still think there's a risk of the big one, the RRR cut. And now we need to see, are they going to do more next month, or are they going to give it a bit of time? But there's still an easing. I'd like to see us take on that prior high up at 719. I want to see that knocked out, even by a few pips. That'll keep the trend going. But if we hold there again, we might find ourselves at a bit of a top, temporary or otherwise.
Okay. And I'm looking at the S&Ps here. Was this a high? It may have been. I mean, we diverged, but the only 4-hour chart in most of my stock indexes or individual stocks, the only one that didn't get over 80 on this last run was this. So Apple, NASDAQ, S&P, most of the indices on this last run got back over 70, and that didn't happen with Apple. So we'll see. I'm just rationalizing holding puts. So,
all right,
yeah,
you got to
look for the clues. So I was just saying, you got to look for those clues, haven't you, Dale? Because that makes a difference, doesn't it?
It does. Sometimes also, what you have to do is if you have a position that's not working, sometimes you have to pretend that you don't have that position. Okay. And just look at it and say, well, what, would I do anything new here?
Yeah.
Or would I do anything here? Forget about what you already have on the books. And that's usually the right answer.
That's usually how I add to positions when it's like profitable positions, or if I'm going to
that's
add
how
to
I rationalize adding on to losers.
Well, that should happen pre-planned. That should be pre-planned, Dale. Hey, I wanted to show you guys a couple of things that I was talking about regarding the yen, and I was looking at and have been, and because you brought up yields, really important levels. You want to watch the 2, 5s, and 10s, so you can see the 10-year right at trend line support. We're in a triangle, by the way, and we're at triangle support. So if we see this break, that's a clue that the dollar yen will, start pulling back too. You got the 5s that are coming down to trend line support, and then the 2s. So the 2, 10s, 5s, those are the ones that you want to kind of focus on to get that, that correlation with the yen. Now, also one of the other things that you want to pay attention to is what happens in the Nikkei, because there's a very, very strong correlation between the dollar yen and what's happening in the Nikkei as well. And you can see we're obviously RSI is very overbought, or was overbought, very divergent, and we have some distance to get back to the breakout point if we start to fail here. So RSI is getting close to breaking, could happen this evening, and you can see the dollar yen is actually trading at its lows. One of the other things that's going to help out the dollar yen is a pickup in precious metals, which because Stelios is bullish, then that means they must be going higher. Just kidding, Stel. I know you're here.
I mean the opposite, yeah. Thanks.
Oh, you're opposite, huh? Well, here's the thing. The gold's still sitting here, range bound, and we did a false breakdown below that 1930 level on Thursday. I want to say it was Thursday. Anyway, we could still make our way back up towards 1980. That again will help with the whole, dollar yen pulling back. Now that's just the dollar, but the dollar across the board is not going to, it might be something different. But here's the charts that, like I said, I know you guys didn't watch the week ahead video, and I don't hold it. I don't hold it against you, because I wouldn't want to listen to myself throughout the weekend either. Here's the long-term Aussie yen weekly chart from 1990. That's basically the financial crisis, pre-financial crisis. What was the bank that, what were the multiple banks that broke? But before Bear Stearns, you had, was it Lehman that broke first? Or
no, Lehman was the moment. So it was Bear Stearns.
Bear Stearns in 07. That's right.
Washington right. Mutual, when Bernanke said it's contained to subprime.
So that was 07, right? And then 08 is the straw that broke the camel's back, which was Lehman, right? So anyway, you can see 30-year trend line plus, right? This is 13. This is 2014. 22. Wow, who's coughing there? Or who's clearing the throat? And then big resistance right here. Kiwi, very similar, but your highs are off of the financial crisis, right? Then 2014, and then where we're at right now. Euro yen, 1990. That is Lehman Brothers right there, the failure right there, and then where we're at and stalling right now. So if you go and these are all weekly charts, guys. This is all weekly. Obviously, we're talking decades long charts. Then you just start going intraday to let me find my other subset of charts here. You go to like some of the intraday stuff and you go, well, look at the euro yen. We've got a double top here at the 161% extension. You got the Aussie yen reversing off the 161% extension. This is just off of the 2023 range. So you can see that we're getting pullbacks right where we should be getting pullbacks from. So when you're looking at the yen starting to reverse here, it's really hard to be bullish risk, and then on top of that, you got obviously you're here at channel resistance, and this is the big conversation we had on the week ahead video is how much upside do we have from here? I don't know. I think it's going to be really tough to get the markets to rally any further over the course of the next couple of months. Now, that doesn't mean that the market isn't going higher by the end of the year. I think we still have to assess whether it's going to be a longer term or we are going to see recession or not. But I do think that the S&P over the course of the next couple months are probably going to be in a fairly sluggish state, as seasonally this is the time where markets do come off a bit. So anyway, that just my thoughts there as we go into this year. So what are you thinking Stelios, as far as risk goes, and what you're looking at?
Well, as far as risk goes, I think there's nothing yet technically to tell us that this move higher is done.
Because you've been right saying that, hey, the market's going to squeeze. It's going to. Yeah, Steve
Volge too.
They've been talking about
it. Go on, sorry.
Go ahead. No, I was going to say a break above 4,200, and you guys are like pain trade. Well, actually, you were talking about the pain trade even down at like 4,000, basically.
Yes.
So I mean, you were talking about the pain trade down here, like. I don't see any reason for it to reverse. So you're saying technically you don't see anything that suggests that it's going to reverse. But how do you feel about, hey, we've had this big of a rally, and let's just call it from the lows of this year. Well, that's all the way down here, or no, that is right here. Actually, the March lows, we're up, 17% in the S&P, and you don't even want to count the NASDAQ from those lows. We are, well, actually, we can go lower than that. Well, basically, we are from the March lows, we're up 31%. Do you think there's more?
Well, I think the correction is long overdue. But for now, technically, I don't see any evidence that this is coming. Yes, last couple of days we've had a little bit of pullback, but I mean, if you look at the daily chart like you have there, I mean, it's just a one-way train. I think we talked about this on the flow show this morning. I think for the S&P, we need to break. There's a first support area around 43 to 43.20. Somewhere around there, but really for me to say, okay, this move lower has legs, we need to break below 4,200, which was the breakout point in the S&P.
But that that's going to be difficult to do. I mean, that's a 7% pullback, or no, 5% pullback from where we're at.
Yep.
I think that's going to be tough.
Unless that happens, I still think this is a buy on dips market, and that's how it's been for weeks now. Do I think it makes sense? No. Stocks theoretically should be lower. If you think about what rates have done over the past 2 years and what the S&P has done and the DAX and all that have done over the past 2 years, it makes no sense. But this has been a one-way train. It's been the pain trade. I don't think it is the pain trade anymore like it used to be, a month ago. But I think it's it's not done probably yet with this move higher. A correction should come. I mean, it really should come. That's what fundamentals say, and valuations and all that. There is just stock indices are rich. But do you go against this now? I don't.
What's the current PE for the S&P right now?
I don't know, but it's a lot.
It's trading at what, 8.19 maybe? Something like that.
I think Gavin on the flow show was saying it's up somewhere around 28 or something for some of them. I think the big 10 or something like that.
Oh, maybe the big 10, but I'm talking about the S&P in general. Maybe somebody 15, here can jump in and let us know.
Rest or something. I think you said.
Yeah.
Oh, 22. I found it on a 22.2 or something like that. So yeah, it's in the low 20s.
That's nuts, right? I mean, that is rich. All right. Well, Ryan, how do you feel
also,
about
one more thing. We still have the situation where a few big stocks are pushing the indices higher, and the vast majority of the rest of the stocks are not. They're down. So,
right.
That at some point is going to reverse, and when that happens, that's a double whammy. So,
that's the other argument. And Ryan, I want to come back to you because I want to ask you about your feelings on risk here. Because if you have somebody called them the Great 8 or Super 7 or something like that. I can't remember.
The Nifty 50.
Nifty, yeah. But it is the Nvidia, whatever, Apple, Amazon, you name it. It's all those big ones. Anyway, the thing is if they do reverse, don't you just see rotation of that hot money going into maybe higher, dividend yielding type of stocks that companies that that are producing some sort of dividend, which more of like maybe some energy companies or some pharmaceutical names. Don't you just see rotation versus a straight up I'm getting out of the Super 8 or Grade 8 or whatever it is, and I'm just going to start buying dollars again because it's risk aversion? I'm not convinced that that's going to happen. I think it just gets rotated out. So anyway,
even if it does get rotated out, it's the big names that move the market. It's also in sentiment, right? If people see, Amazon down, 10%, Apple, Nvidia, and all the others, sentiment hinges a lot on those big names.
This is the equal weighted S&P ETF. If you guys don't know it,
and by the way, it's a different picture.
Yeah, it sure is. And by the way, that is a Gartley pattern. So, Ryan, how do you feel about risk here?
I mean, I think I'm on the same side as Stel. I don't think we're potentially done. I think there's still a lot of people in the wings who want to come out and chase this move higher. Maybe didn't do so over the Fed or thought they might get better levels, and there may be some latecomers to the market. But then you've got to look past that. I think what is it going to take to get stocks much higher? In the same way, you're asking, what would it take to get a decent dip down to 42s, or what would it take to get us up to 46s? I think the arguments on both sides.
I have an answer. The banking index, and that if you look at KRE, Blake,
You think the KRE is going to pull the market to 4,600?
42. If it
Oh,
makes
we'll see.
new
Ryan,
low.
okay,
Look,
Ryan was asking what could carry it to 4,600. So,
okay. I
No,
thought
both sides. Both sides. You got to look at both sides of the coin. And Dale's been talking about the banking stuff for a while now, and that still might be bubbling. We got the stress tests. I think the US stress test coming out the 28th of June. So if there's any skeletons falling out of closets, that's the day it's going to happen probably. So that
they're
might
probably
be
rigged.
yeah, that's the day to put on your post-it note.
They ought to do a stress test on me. Yeah, and I'm in worse shape than the regionals. So
I'd still buy
anyway,
you, Dale. I'd buy the dip in you. I'd buy you on a dip.
Okay, thanks, buddy. I have some relative strength left.
Hey, guys, we actually have Grega here, who popped in for a few minutes as
and I think he could go. He can go for a while because Forex Guest Hunter is not successful so far in finding down direct. So
okay. Well, hold on. Do we have any data coming out today? Let me make sure.
Yeah,
we have
starts
building
and permits.
permits.
Yeah,
and
housing data.
When you talk about housing, and I'm just, here's the difference. And Scott, by the way, just he mentioned a little bit about the Aussie rates. So Scott, thank you for all the comments. He said, doesn't auto reset. They're automatically variable rates, constantly moving, but you can choose to have a fixed rate for a max year of 5 years. Then it will reset at either a new fixed or chosen variable, if not at whatever the rate is at the time. That sucks because.
wow. Yeah.
Man, imagine if you get stuck in a 1980s, inflation trap, and you're in Australia, and next thing you know, you're paying like these huge rates, that are variable. It's just a tough life. And this, you go back to the housing market and you talk about where, like in the United States, most of us that own homes, we refinanced at when we got rates below. Most people are below 4%. I happen to be 2.5%, and so there's a few people that actually are below 2.5%.
So really, Paul helped a lot of people.
Well, but here's the thing: it's also how should I say?
The structure.
It's effing them too, because they're trying to slow down the markets, and now you got a liquidity problem or not a liquidity problem.
Yeah, people just walked away from their mortgage in 08. I don't think they're going to do that at 3%, Mike.
No, they're no way. They're gonna
unless they lose their jobs.
Hell or high water, man. I'm gonna let my credit cards expire, or I'm gonna let them do what do they do? They'll default. They'll default on those. They'll have people come grab their cars out from their front yard. They don't care about any of that. They'll keep their house at all costs. So at these rates that you have, and then so now you have a housing permit and housing start issue, which we're going to have those numbers here in a second. So you have not found your guest?
Not yet. No.
Okay,
let's bring in Grega.
Grega, yeah, well, of course we're going to bring in Grega. Sure. He's ugly though. I mean, if he was a better looking dude, I might, Hey, Grega, how's it going, man?
I'm fine, thanks.
Hey, listen, we're gonna bring you on here in just a second. We got this housing data that's coming in, so stand by with some charts, because I don't know if you caught what I was saying a little bit earlier about some of these longer term yen pairs. I'd love to get your view on the yen, on the S&P, what's happening in the metals, and some views here in a moment. So as Dale's skating around, let's just wait for this data to come out. It'll be out in about a minute. But how are you been, Grega?
Well, just from lunch, just now.
Just coming back from lunch?
Yep.
Very nice. Did you get did you have Burger King?
I was in Chinese restaurant, so.
Did you say Chinese?
Yep.
Oh, how's the Chinese food in your neck of the woods?
Well, apparently good.
All right, that's awesome.
I'm there once per week, so.
Okay, wow, that must be good.
You're celebrating Blinken's trip to meet Xi. You went out and had some Chinese. Good for you. What we want, what's on the menu with wave counts, bro?
Dollar weakness.
Yeah.
Dollar weakness. So
I saw
you
you
see
flipped.
continued dollar weakness. All right.
Yeah.
I'm
Yeah.
now you got my attention. Because I actually think that the dollar's consolidating near term in this lower end of the range of the dollar index, but
Strong numbers. Very
strong
strong
numbers.
numbers. Very
Yeah,
strong numbers.
Well, they have to. They've got to start building to build up some inventory because, I mean, people aren't selling. No one's selling their homes. So
BlackRock will just buy these anyway.
Yeah, I don't know, man. That's but
they're going into crypto now. They're going to have an ETF.
that's crazy, right?
Yeah.
Not so. Well, anyway, speaking of crypto, I'm going to leave one last thing, and I want to pass it over to Grega so Grega can take a look at the charts. I do want to show you guys this for those of you that don't see it. Bitcoin did hit channel resistance this morning at 27K. Now, we've been looking at 27K as being key resistance. Even yesterday, we looked at that. You can see it right here. We were looking at the 27,000 level as being really critical resistance. And we hit 27,100 and something.
My guest showed up.
Revert. Oh, he did.
Here.
Your guest is here. All right. Hey, Gregor, real quick before Dale takes over, can you just show your count on the dollar? I think everybody would love to see that.
Sure.
Show it real quick. Dale's got his guest here, so Dale's going to work on bringing him on over, and then let's see your count.
Okay, so you can see the charts.
Yep.
Yes.
Yeah. Okay, so I think that this is a corrective phase here, ongoing, maybe still as a triangle, maybe as a completed flat from January, February. So I think that sooner or later we will resume lower. I believe the dollar index will hit 100 and potentially much lower levels in the second half of this year. But we could be chopping around here through the summer. If we don't see a break immediately, let's say in the next 2 weeks, continuation towards 101, then this triangle could be very possible. But in either case, I think that that's a corrective phase, and that prior that we had an impulsive drop. So I think that more weakness for the US dollar is coming while the stocks are resuming the uptrend. At the same time, metals,
Greg, I'm glad you put that in a wave count form, because that my view is exactly that on the dollar over the course of the next few weeks too. That's exactly what I was saying on the week ahead video. Is we're in some sort of triangle consolidation at these lows, so that's good.
Yeah, and at the same time, I would like to mention that gold is still pretty low compared to where the dollar index is trading for the last 2 weeks. How it fell. So I think that there is a lot of much more upside potential on gold.
Okay.
All right.
Back to where, like 2000?
Yeah, I think that's very probable.
Okay. Thank you, Grega.
Thank you.
Great to see your wave count. And now I'm going to bring in Don Dawson. Don, I'm glad you showed up and you got my email. Great to have you back.
Thanks, Dale. Happy to be here.
So, Don, what's top of mind with everything that's been going on since you and I last talked? Banking problems, Fed pausing. I know you're a technician. Did you bring some charts to show us what you're thinking about in the markets?
I don't have any charts set up, but I can tell you, the Fed obviously has been playing a role. They're even impacting our commodity markets, which is my sort of forte. Because commodities are tied to interest rates, because there's a carrying charge that commercials have to pay when they borrow money to store commodities or to purchase these commodities. And when those rates are going up, it's making the carrying charge to be more expensive. That's impacting commodity prices, along with now we have the drought conditions in the Midwest that are going on, which came in about 2 weeks ago. So that's really been playing havoc in the corn, wheat, soybeans, all that.
Yeah.
Wheat really just even a winter crop had a really bad winter. And a lot of the people out in Kansas are just sort of plowing that crop under because they don't even see a profit margin in it this year. It's just not growing enough. So
I've been telling people to build a silo and fill it up with wheat for months now.
Yeah.
Early. I'm always early, but so really the super cycle in commodities isn't over, but it rotates. And are the grains your favorite sector in commodities right now?
Yeah, that's well, it's a weather market right now, right between now and
Right.
July, basically, and you'll see a lot of panic in the market with every day getting a different weather report. So that you got to be a little bit careful trading in that environment. But yeah, the grains are going to be some hot commodities for the next month and a half or so.
What was this opening, Don? Was there a crop report that day that took beans down? I think like 8% on the opening.
It looks like maybe you're on a continuous chart, and that was the July rollover into the November.
Okay. Okay. All right. So that was, I was wondering.
Yeah.
What the heck? Yeah. All right. And the corn looks good.
Yeah, if you're on a November bean, you wouldn't see that like the X contract. But yeah.
Okay. What about the metals in here, Don?
Yeah, I'm actually been bearish on gold in the sense of prices coming down, not a big drop or anything, but I'm looking for, I wrote an article for Bar Chart on this recently too. I'm looking for a big rally in gold and also the dollar at sort of the end of June, beginning of July, on up until about the middle of August. And that's typically a seasonal pattern that we see quite a bit in the market for the gold and the dollar, which is ironic because most people think dollar and gold are inversely correlated. But there's a 15-year record showing that's not necessarily the case for that period from July to August, which I can show you that I have a MRCI seasonal pattern. I'd be happy to bring that up on the screen if you'd like to see that.
Yeah, sure. I'm going to stop sharing, and you just go to the bottom of Zoom and share the screen.
Do a share here. Okay, cool. There we go. And I'll make this a little bit bigger here. This is just, I'd written an article here last week, I guess it was, about copper. And I'm just looking, copper had a nice little run up, but we typically see copper from October through March. That's a typical rally. That's a 15-year pattern right here for the market on the black right here. So for the past 15 years, this is what the September copper contract has done, basically from October through March. And that's really just getting ready for the home building season in the copper market, where, selling copper for people who make or companies who make pipes, electrical wires, PC boards, everything like that. So really high demand time for copper. And then after that, it just dwindles right on down into where we are now. And now you just start seeing this choppy stuff here on up until we get into October, and then, get new demand coming in. There's a lot of talk that China was going to come back and start buying a lot of stuff, but I think we can all see that China is not coming back online anytime soon. I think there's even been some comparisons to China and Japan, because Japan went through the big housing crisis, what was that, right, 10, 15 years ago. And there's some comparisons now that China's going to go through that same effect. So I'm not in the camp that we're going to see China back online like they were with double GDP before COVID, basically. I don't think we're going to see them back for a long time, to tell you the truth. So I'm not putting China on the board for being big buyers anymore. They might speculate or rumor, but I'm just kind of discounting them. So that's why I'm more than happy to think that we're just going to go sideways to choppy on copper here.
Okay. And, I was thinking about your call for, I think you said late July for long gold and long dollar simultaneously.
Yeah.
And that sounds like a geo event to me, or a big risk off event.
That's
when that happens.
And some of that might be tied to, because the U.S. government's fiscal year end is September 30th. And some of that just could be repatriation of dollars coming back, on a regular basis at that time of the year. I'm not 100% sure what causes that, to tell you the truth. But I'll show you a pattern here, and we can see.
So is this all your work with these indexes here? What is this that we're looking at?
These are, okay, it's a company called More Research. And
I know them.
Yeah, I've been using seasonal patterns. Where people, I think, make the biggest mistake with seasonal patterns is, More Research puts out a weekly commentary where they talk about, buy on this date is an optimal date, and there's an optimal exit date. But there's nothing that cyclical in the markets that you can buy something consistently on the same date and sell it on the same date every year. So really, if you use them more as a window of opportunity, and then compare them to your technical analysis and make sure you've got the right trend, something is supporting it. You can't just come in here and say, oh, there's a seasonal pattern I'm going to buy, because I can't tell you how many times in the past I would have bought something if it was 100%, meaning for the last 15 years, it's done the same thing.
Next year, it don't work.
7%, right?
Price is king.
Yeah, I don't get too excited about
king,
that. So
right?
This is what I like to use the research for More Research, and they're just reports. You can buy these reports from them. Here we go. There's my October. Let me just pull down here December.
There's Yeah.
Yeah, and so here's your, and it's contract specific too. So that, there's a December contract, August contract. So each one of these markets, believe it or not, have their own characteristics to them. So that's why it's interesting too, why you don't want to just clump all of it like a continuous chart to do your seasonal analysis. I know some people have all this new software out there that does their own seasonal analysis on their home computers. But if you don't understand the concept that you can't just clump continuous charts together and come up with seasonality, because a September, well, in the grains especially, you got planting season and harvesting season. Those two crop months are 180 degrees out of sync, what seasonality is, right? So you can't just clump together those on a continuous chart and expect to get accurate information. So in the futures, you're much better off looking at contract specific, not continuous charts. So if you want to get real price action, or price levels, I should say. But here's a December contract. And basically I went to December because that gives you all 12 months down here of the year. And you can see back here, we have January right on up until it's February, March. And that's a typical rally that we have. And you can see with the charts of gold that, we get that peak. And this year we had the same thing. And then we tend to just go sideways here for a while until we get to July. Now this year, this little rally here, the April rally, took us up a little higher than what we did back here for the seasonal high back here for February. But if you'll notice, we did not go very far beyond that. It hiccuped and, sideways and everything else above this. It just couldn't get any traction. Now it's just meandering back down like this. So this is what I see this thing coming in here and doing. And you can see here as we get towards about the middle of July, end of July, this is just a very beautiful looking rally that we have right here. August is a very strong month for gold. So I always try to encourage people, if you're trying to get into gold, like if you're an investor or something, start timing it around some of these seasonal lows, where times of the years where you're going to see some lows. Start putting money in there. Don't buy something just because you have the money today, because you end up buying it up here somewhere, right? So think about, and I'm not trying to tell you to time a market, but use a little bit of horse sense and think, hey, this is when the market typically makes some lows. Why don't we start looking in this time frame to get, put money into the market? You'll get a lot better returns, in my opinion. But let me show you the dollar index on this as well, because this is just an ironic coincidence how this worked. But July through August, pretty good looking rally there. Let me get back up here to the menu again. It's down, but here we go. Dollar index is going to be 104.
Great presentation, Don.
Sure.
We don't get good seasonal presentations like this.
I figured you guys a little bit more on the Forex side. Probably don't get much of that.
Well, and not seasonals on them. So, I mean, this is really excellent stuff.
Yeah, and this is ironic because a lot of people don't feel there's a seasonality in the currency markets or in the interest rate products or in stock indexes because they're paper assets. And every market has seasonality to it. As a matter of fact, we're got a pretty good one coming up here in the interest rate markets as well. And that's tied into the government's year end in September 30th, where basically from around end of June, I believe, up until about the end of August, interest rate prices typically go higher and yields go lower. And this is like a 98, 99% occurrence over the last 15
lower
years.
Yields? Because that's what my technicals are saying.
Lower yields, exactly.
All right.
And all that is just the government doesn't have to issue as many. Well, it starts with the April tax season. It starts giving the government a little bit more money so they don't have to issue as many bonds.
I heard from Luke Groman it was a bad tax season.
Oh, really? Okay, for the government, huh?
Well, the receipts are down 20%.
Okay, well, maybe after Biden hired all those gunslingers, they'll go out and get that 20% back and some more, right?
Yeah. Uh-oh.
But anyway, that's one of the beginning times of where the money starts coming back into the government, so they don't have to issue as many bonds. So that's less supply of bonds. And then as you get to the government's year end in September 30th, then they don't have to issue as many bonds. So those two occurrences happening right there every year tend to make a little rally. I shouldn't say rally; it's a decent rally in that market. I can show you that chart here in a little bit.
All right. So what are we looking at? The dollar bottoming in early August.
Yes. So here we go. We got over here's our July for September contract for dollar. Yeah. So you can see here's your bottom right here for same concept, pretty much gold just sort of working its way down, dollar working its way. But look at the same consistent pattern, nice strong rally right on up in here until about the 1st of September or all through August. But this is the same thing gold did, right? And most people say, no, that can't happen because they're inversely correlated. Well, correlations, you got to take with a grain of salt, okay? Because there are certain times of the year where they are going to go in the same direction. And then sometimes it's just because of the news events that are going on. Sometimes stock prices and interest rates go in the same direction when there's a portfolio reallocations that are going on in the markets. That can happen, but anything can cause correlations to go out of sync, just like a seasonal pattern can go out of sync with a bad weather pattern one particular year. So we can't, just because something's on paper or on a screen, we can't take that and go like, oh, that's written in stone, we can take that.
Yes.
That's not the case. So always do your own analysis, do some due diligence and confirm that. But on here, this is a 15-year pattern, and also the 30-year pattern is on here, but the black one is 15. That's the one I like to pay attention to. So when you have gold and dollar making these kind of sort of odd moves like this, that's what I'm kind of leaning towards the end of June, or I should say July in this case. But as we come into that, getting long on this gold and something on the dollar as well. But in the meantime, I think we just got some sideways money, especially in June for gold. It's just sideways.
And the dollar after Friday's move looked vulnerable, so we could
That
be
was
at new lows.
Huh? Yeah, I don't know if that was a technical event. Some of it.
It was news driven by the ECB.
And the Fed did come out and say we are going to raise rates more, right?
Yeah.
And they just said that we put the brakes on things here. And I think the problem is too is we've got an election year. Well, your figure is going to be starting up for next year for the 2024 election coming up. That's going to put a cap, I think, on interest rates going very high, because the Fed normally doesn't get too aggressive in either cutting or raising rates coming into an election year like that, because they don't want to try and look like they're playing either side, even though we know that's not true with the Fed. But anyway, I think that's going to have a play on it as well. But they did say that they will have to raise rates again, because they're not going to get down to that 2%. And I don't know, what do you guys think about this? But I think their new area is going to be a 3% target, not 2. I think 2 is, it's like the old days of 0% interest rates, right? I don't think we're going back to that anytime soon, I hope.
Right.
No. But on the other hand, I think 2% is going to be, with the way salaries are and everything today, I think it's going to be a very tough target.
Yeah. They chose a couple of real rough targets with shortages in both labor and housing.
Exactly. Yeah.
Yeah. So you were going to show us the seasonal on yields and interest.
Yeah, let me
rates.
show you that really. Yeah. Thanks for reminding me.
That's what I do.
Yeah.
I don't remember what room I'm in, but I can.
Yeah, but you're good at reminding other people, right? That's good.
Yeah, you ever walk into a room and say, "Why did I come in here?"
Oh yeah,
what did I come here for?
About those. I don't really like thinking about those times because they happen too often. It's that thing about getting old. It's just not good to me.
Yeah. Well, if we can read a chart, we're okay. We don't have to know what room we're in.
I'm with you on that. So, okay. All right. So my 10 years down here on 62. And 10-year, by the way, that's the benchmark interest rate. That's the one that has the most volume, most liquidity, and the most popular one, even internationally. Foreign countries, if you take Japan, Australia, their benchmark is a 10-year as well. So our country finally, back in 1998, I think it was, finally went to the 10 years, the benchmark. Used to be the 30, but 10 is now the benchmark.
And all your writings and research are on barchart.com,
yes,
right, Don?
Yes, they are. I can show.
Is there a difference between stockcharts.com and barcharts.com?
I think so. I think their bar chart does a very good job. They got a lot of analysis information you can do in there. And it's also, you can do futures and also on the stock side. So I think stock chart participates mostly on the stock side, but bar chart has got a good blend. So you can get a taste of both sides.
Do you guys have a channel where you do like stream your research?
John Rowland does some of the work on there for let's say what we call it. It's like their futures events, and also on the equity market as well. And they talk about how like using options for certain strategies in the market and so on like that. We get on there and talk sometimes about the commitment of traders report for the future side. So they got a pretty good blend of that, and they put those on a regular basis. Maybe I think they're weekly, and then every Friday they have a market on close commentary and stuff like that.
Okay, nice. So people go to barchart.com. I just wanted to ask that question because people probably think it's the same. It's not the same company. They're different companies. And I started using barchart.com, I don't know, 15, 20 years ago.
I actually keep their little app on my phone. It's just delayed quotes, but anytime I'm out somewhere, and I usually do overnight trading or swing trading, trend following. So I'm really not day trading anything. So I don't need up to the minute when I'm out on the road. But I think it's just a cool little thing. You open it up and you can see all the quotes or open a chart super fast, and it's pretty nice. And that's a free feature they have, so it's not even charged for it.
So we were due for this low, high in yields, low in prices, because this is a 10-year note SEP, and it looks like it's bottoming now. Yeah.
And right here, this would be in your June timeframe right in here, but this is that pattern that starts. And remember, these are the prices going up, not the yields. So if the price goes up, the yields go down. And this is interesting because last year was one of the most brutal years for interest rate markets as far as a bear market. I mean, it didn't work.
Did it work though?
Yes, exactly. That's what I wanted to point out. Now, as bad as last year was, if you go back and look at your charts, you'll see that June through August, we did have a rally in that. And it was just, I'm like, where did that come from? Of all the years, I said, there's no way that thing could work last year. And it did. But that's just how consistent this works. Now, it fell like crazy right after that when that August seasonal came through, but boy, it worked going into that. So it's just such an interesting pattern here. So here's a pattern now where you can see July and August really, here you got treasuries rallying, gold rallying, which is probably a common thing because that's typically what happens. If yields go down, gold wants to go up. So you can watch this and see, hey, if interest rate prices are going down, that's going to be another tailwind for gold prices to go up. And then also you got the dollar going higher. Now that's the oxymoron, and everybody's going like, wait a minute, how does dollar?
Sounds like flight to quality to me. And if you don't mind, maybe we could wrap it with seasonals on risk, like S&Ps or NASDAQ.
Okay. All right. Yeah. But it just tying these three together at this time of the year. And this is what I really like using these type of seasonal charts for. I don't come in here and try and catch every one of these wiggles because you can imagine they're not going to be accurate when you're doing that. I'm looking for some really, flat bottoms like this and significant, slopes like 45-degree moves like this. Like all this down here is just kind of choppy sideways stuff. You don't get too excited. But when you see something going for like 2 months in a row in the same direction, very strong like that, that catches my eye. And that's where I start looking for my daily charts for the trends to start. Okay, let me get some uptrends in here. And I want to get long these markets. And that's
that'll
really
give some of the regional banks a chance to cut their exposure to the duration risk that is bankrupting them.
Exactly. And this also gives the Fed, because remember, they're selling their asset or they're selling their securities as well. This gives the Fed a chance to sell them at a higher price as well.
What a coincidence.
Isn't that amazing?
What a miracle.
Everything, right?
It's not the if, it's always the when.
There you go. The seasonality on the indexes, I feel like they're a little bit distorted, to tell you the truth. And the reason is because of the bull markets that we've been in, right? They did not do well during the bear markets of this, simply because of all the times that we had, there's S&P 186
shocks.
Yeah, it was not anything that happened in the last 15 years. So it really distorted the seasonals. It's gasoline. She's done. Said,
I think it was 66.
60. Okay, there we go. What's 10 points? That's not gas. Let me. All right, this time I'll pay attention. There we go. 86. Good grief.
Okay. Boy, these guys do, this is a lot of work, time-consuming work.
I just find this stuff super. This is, some people have like stock screeners, and you got them because look at 8,000 something stocks. You're not going to sit there and look at each individual. So if you have a screener, and that's what I use these seasonal patterns for, like on my Sunday analysis when I'm getting ready to come in for the week. I like to scan through this, and even my daily worksheets. I've always got a place. What's the seasonal trend, up, down, or sideways? And I just put those on my worksheets. And if I see something, kind of catches my eye, then that's kind of a market that catches my attention. And then I want to start doing, okay, are the fundamentals, is there anything in there that could distort this thing, or is it going to support it? And then it's the technicals coming in. Do I have a trend in the right direction? Where is the support or resistance that I can get in this trade? How do I manage it? And that's pretty much how I get the trade started. And I found that if you can catch on to them, now, again, they're not perfect every year. I mean, I've gone in trades that looked super good and they just didn't work out. The geopolitical event, a weather event, anything like that, or any supply. Believe it or not, the Mississippi River flooding or being too dry can disrupt a seasonal pattern. It's just silly stuff like that. But if you keep your ears open and listen for those kind of news events or macro events, that will help kind of tip you off on like, okay, this doesn't sound good for our seasonal this year. But anyway, you can look here on the S&P and you can see because we've been in a bull market for, you know, how many 1.5 million years now. And so it's going to have a natural tendency to go up all the time. So it catches some of these right here. We get a little bit of these typical corrections here. Some of those could just be quarterly events and so on like that. But for the most part, the bull parts, they do catch pretty good moves on simply because that's what's happened in the past. But it's the selling or, you know, the peaks that get a little bit more erratic. So, you know, if you think about what an S&P 500 is anyway, it's an index of 500 stocks that gets sort of what we call it reallocated every year, where they take the poor performing
the weak ones out.
And replace it with the strong ones. So if you think about it, this is why I always encourage people. I say, if you're putting money in investments, don't worry about stock picking. Just put it in an index fund. Don't be unhappy with average. It's not bad being average. But the thing is, it's like, which way can that thing go over the long run? And that's why when you look at a monthly chart, it goes from like 50 to, you know, 5,000 at a nice 45-degree angle, basically. So it just doesn't make sense to fight that uptrend on this, you know. I mean, and you see bear markets like this last one we had was pretty darn grueling. It wasn't anything. I mean, it didn't wipe you out like you did in, you know, 87 where it fell 25% in one day or anything like that. But it was just grueling. It was like, please, would this thing move or just go don't quit going sideways so much, you know. But when that kind of a thing happens, that's where investors just they lose so much patience and just want to jump out and you know, usually at the bottom. And then next thing you know, the market's back up to where we are now. And I don't know about you guys, but I have struggled with this market. I mean, I felt like this market, and I still almost do to this point, that does not have a leg to stand on when there's only a handful of stocks that were making this rally. And now it appears there's more stocks coming into the rally. So I'm going like, wait,
broadening out
everyone's
now.
late coming to the party.
Yeah. Well, I'll tell you what, one thing I can say is you really laid out a lot of great things for us to put in our intelligence gathering in the months ahead with the gold, the dollar, and rates. And
well, thank you. Seasonality really, it's worth paying attention to, and just don't try and think of it as, you know, the holy grail because it is not that. And even more research will tell you the same thing. But they put this analysis out here, and it's very supportive for our trading, especially if you're looking for markets to screen. For currency traders, here's another one that plays out really well, and that's the Aussie dollar. If you've got a minute, I can pull that up here.
Yeah,
really
sure.
quick.
I just covered shorts.
There you go.
So
their fiscal year was just ended recently. So that I think that short is what's been playing well in that Aussie dollar. There you go. Aussie is 107. We'll pull March up because that's usually there we go. Here's the March contract.
Okay. So we're okay.
Here we go. So here's, I'm going to use a September contract because March is going to be ending about the time of this rally that we're looking for. But if you see this peak that we have right up here in the April period for Aussie dollar, as we come in here in this February and March timeframe, this rally is coming because remember they're in the southern hemisphere, we're in the northern hemisphere up here. So their crops, which is something that they do a lot of exporting of, they export a lot of commodities, which is one of the reasons I like that currency to follow. And it's not as affected by the US dollar as other currencies are, even though it's paired to the dollar, but it doesn't wiggle like, say, a euro or something like that when events happen in the US dollar. But this is an interesting pattern because it's tied to a crop, and crops are very, very cyclical, right? I mean, I don't care what country you're in, you put them in the ground at the same time every year, and you take them out of the ground at the same time every year. If you have foreign countries buying so much of your product, and their harvest season is in February and March because it's coming into fall while we're getting spring getting ready to start, their fall is starting, so that's their harvest season. Mm-hmm. When countries come in to buy their crops or any of their currency or commodities for that matter, the first thing they have to do is sell their currency and buy the Aussie dollar. So it puts a bid in the Aussie dollar every year around this March, especially March timeframe. But this is just a beautiful little play in the Aussie dollar. And then if you go look, you'll see, I believe this is the Australian fiscal year end comes in around here somewhere. But this pattern is so reliable. It's almost as good as that 10-year interest rate.
But
product.
we're in June now, right? So
yes,
what's the outlook? So that we put in the bottom in May and we're up until July.
Right. And what you'll see, and notice this thing here, and remember what we were looking at on gold, how it just sort of meandered down in June, right? Interest rates are down in June like this. Same thing. Now look at July. See, there's July. It's got a really good boost coming up here for the Aussie dollar. So you got gold going up, Aussie dollar going up, interest rate prices going up. July, August is going to be really good, I think, for trading. So
okay. Well, this was real good to prepare people for that time frame, Don.
And that's what I try and do on my bar chart articles, Dale, is to write about upcoming events that might be 3 or 4 weeks away. But it's better to be prepared for it than have it say like, oh, yeah, last week, something like that. But gotta give people a couple of weeks ahead to plan for, and it gives you more of a window because there is no particular data that always turns on. So you got to find that window, 5, 10, 15 days within a seasonal window and go like, okay, here's where I'm looking to get into this trade during this period. And then it's just using technicals to confirm it and boom, take off.
Yeah, it gives traders time to mentally prepare for it. I mean, anytime you go and say you're a pro athlete before a game, there's preparation, mental preparation. Warriors, they prepare for battle mentally, and trading is like that. It's a bit like a battle, and you have to prepare yourself so that you can, know your plan and stick to it.
Totally agree.
Really a great interview, Don. I'm very glad that, forgot who referred you to us, but every the last 2 times you've been here, I've learned new things from you, and you've edified the whole community. So much thanks. My trading warrior brother, everyone, my trading warrior brother, Don Dawson. Go to barchart.com, check out his charts and his articles, and you'll be a better trader. So again, Don, thanks very much, and I'll send you the clip when I have it, and we'll set up another time for the fall, see how these seasonals worked out.
I look forward to it. Thank you very much. And if we have some interest in the seasonals and stuff like that, we can put something together for the next show for an upcoming trade and see how that would help traders.
Oh, all right. Sounds like a plan. Don, thanks again. Everyone's thanking you. Mandy, I don't know if you know her. She's from Australia, but everyone thanking you. And so it was appreciated by the whole community. Thank you, Don.
Well, thank you. I'm doing a lot of podcasts in Australia right now. It's pretty interesting. A great group of people down there. So thank you.
All right. So he's not only tracking seasonals, he's talking to people there. And you can join the team in 13 minutes for the morning edge. Everyone have a good day trading, and don't just count your pips, count your blessings. Adios. Thanks again, Don.
Thank you. Bye-bye.